Welcome to Module 2, The History of Venture Capital. In the 19th century, there was a lot of money to be made tracking down sperm whales off the coast of Massachusetts, harpooning them, melting down the fat into oil, and bringing the bones ashore. A single voyage could bring in $100,000, the equivalent of over $3 million today. But it wasn't easy. Around 2/3 of whaling ships that set sail returned without making a profit. As it turns out, whales are hard to find, and even harder to kill, with the average whaling boat spending over 3 years at sea. So this created a dilemma for the wealthy families of Massachusetts: how to kill the whale, sell the fat and bones, but not lose money paying crews and hiring out extra boats for those long failed voyages. Well, there were these folks known as whaling agents, who were responsible for the purchase and outfitting of the ship, the hiring of the crew, and the sale of the catch. They were funded by these families, and to give them an incentive to cut the best deals possible, the agents put up a big share of the investment. Those with the best reputation received better terms from the other investors. Whaling agents were quite shrewd, and they devised a number of clever techniques to make the investments profitable. They studied which captains had the best records, helped rich families spread their money between multiple whaling ships, hoarded knowledge about the best whale hunting grounds, and drew up profit-sharing agreements to incentivize crews to stay out at sea. As we'll see in the course, these whaling agents effectively created the backbone for contemporary Silicon Valley venture capital firms and their profit structures. Fast forward to the late 1940s, and a professor at Harvard Business School, Georges Doriot, started an investment firm called American Research and Development Corporation, or ARDC. ARDC was looking to take advantage of all of the new technologies that had been developed for the recently ended World War II. ARDC made a number of bets over the coming years, and they certainly had their misses, such as a tuna fishing outfit in the South Seas and a machine for deveining shrimp. But in 1957, they hit it big with the bet on the Digital Equipment Corporation, a startup founded by 2 engineers from a federally funded MIT lab, one of whom had developed aircraft defense systems for the military. After bringing the first popular mini-computer to the market, DEC became one of America's largest computing companies. Doriot turned a $70,000 investment in DEC into a $38 million return, or a 500x return on investment. Effectively, he validated the long-tail investment approach that undergirds modern VC financing, the idea that making a lot of long-shot investments in early-stage companies will pay off eventually, especially if one makes it big. Finally, in 1958, the US government started a program allowing for the creation of small business investment companies that would receive cheap government loans and tax breaks in order to invest in other small companies. At a time when defense spending was being cut back, this helped to channel private capital toward investments in the new electronics needed for the arms race. It's no coincidence the law was passed a year after the launch of Sputnik, in a way that avoided interventionist industrial policy and appeased the rising focus on small business. By the mid-1960s, there were hundreds of small investment companies, some with very close ties to the military-industrial complex. Through the 70s and 80s, you saw the proliferation of venture capital through the formation of established funds and enduring companies, as we'll see in the coming slides. And just to put a bow on it, whaling all but disappeared as an industry after mineral oil supplanted whale oil as a fuel. But those business structures pioneered in the Northeast remain as relevant as they ever were. Without them, the tech booms of the 1990s and 2000s and today would not have been possible.